Hello and welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll discuss the market rally driven by the so-called Magnificent Seven and the impact on stock market valuations. This is an important topic because the stock market continues to reach new all-time highs. Some investors may be nervous as they wait for the market to pull back. Others, on the other hand, may feel like they're missing out. In the next few minutes, we'll show that regardless of how you feel in this market environment, the time-tested principles of staying diversified and focusing on the long run are still the best ways to achieve long-term financial goals. First, this chart shows the performance of the so-called Magnificent Seven over the past few years. This group consists of 7 fast-growing technology stocks, including some of the largest stocks in the S&P 500. You can see that these stocks have performed very well over the past year, contributing significantly to the broader stock market indices like the NASDAQ. However, it's important to keep in mind that these stocks are also quite volatile, losing nearly half of their value in 2022. Thus, it's important not to focus too heavily just on the past year. Second, the market rally has pushed valuation levels higher. Valuations are very important for long-term investors since they tell you not just what prices you're paying, but what you're getting for your money. After all, when you invest in a stock, you're buying a piece of a company. The hope is the value of that ownership of the company will rise over time. You see from this chart that valuation levels have increased significantly over the past year. This includes not only the standard price to earnings ratio, but also price to sales, dividend yield, and more. It's important to understand that these valuations are not a market timing tool. Instead, they are guideposts to help us understand how to allocate funds in a portfolio. Higher valuations do not mean that we should avoid stocks altogether, just that we should be more cautious and diversify across asset classes and sectors. If the economy does continue to grow and corporations increase their profitability, then valuations might improve over time. Beyond valuations, one concern that some investors may have is that a small group of mega cap tech stocks are driving the whole market. While this has been the case to some extent over the past year, historically, many stocks have contributed to broad market returns. This chart, for instance, shows the difference between a standard market cap weighted S&P 500 index and an equal weight index. This distinction may sound technical, but it's actually very easy to understand. Using a market cap weighting provides a better sense for where the dollars in the market are. In contrast, using an equal weight means that smaller companies are just as important as the larger ones, which helps investors to diversify. This chart shows that over longer time frames, an equal weight index has done quite well. Thus, we should not overreact to today's tech rally. It's important to stay diversified to take advantage of the gains in the tech sector while maintaining exposure to other parts of the market as well. We hope you found these insights valuable. If you'd like to discuss any of these topics in more detail, please feel free to reach out. We look forward to speaking with you soon.